Welcome back. Markets are waiting for Thursday's U.S. inflation report, which could offer some evidence on which way the Fed may go in terms of the timing of its next rate cut. The rise in unemployment rates in both Canada and the U.S. last Friday is a trend likely to continue, according to our next guest. Our next guest is Veronica Clark, an economist at Citi, who watches all of this, of course, very, very closely. Veronica, what are you expecting in the U.S. inflation report? I believe the consensus call as surveyed by Bloomberg is for 3.1% annual inflation in the month of June.
Yeah. Thank you for having me. We're right around consensus also. I think the most important number at 8:30 on Thursday is going to be that month-on-month change of core CPI. That's what's really going to give us a read on core PCE inflation, which the Fed targets, expecting that to rise by 0.2% month-on-month. That's a pretty standard, typical pre-pandemic increase. So I think Fed officials will be pretty encouraged by that. Even in some of the details of this June inflation data, might see some slowing in shelter inflation, things that the Fed has been waiting for a while. So I think this will go a good bit in giving them more confidence that inflation is easing.
So if the expectations are correct, you think the Fed will get a report that it will look upon favorably. To what degree would that buttress the case for a September rate cut?
Yeah, it could go a long way. I mean, we know that the Q1, the 3 months of Q1 inflation data that really put a wrench in the Fed's plans to be cutting had much stronger inflation. It seems like 3 months are maybe what makes a trend, and they've been encouraged by the last couple. We had a much softer reading for May. This would be the third month in a row of some more favorable data, especially those details. If we see that slowing in shelter inflation that's been consistently strong, it's a very sticky component. You reasonably could think that upcoming months would also be slowing too. So that I think will go a long ways in encouraging them that inflation is slowing. They could be then signaling at the July meeting that they might be cutting in September.
And that certainly has been the message from Jerome Powell this morning in Washington, hasn't it? That the Fed will remain data dependent as always. And he's even taken the step of saying, look, going too early or going too much on rate cuts could simply reverse the progress we've made on inflation.
Yeah, Powell is of course very cautious to not give any explicit timing on when the Fed might be cutting. He's not giving any forward guidance at this congressional testimony. But I do think the Fed officials, especially Chair Powell, are probably seeing that the risks to their mandate, the inflation mandate and employment mandate, are really in much better balance now. We have had this weakening of the labor market. Inflation is coming down, and on inflation alone, they probably could have that confidence that they're cutting by September. But as the unemployment rate is rising, they probably want to get there as soon as possible, maybe as soon as you get that confidence on inflation.
I know you've been watching on the rates of unemployment closely, and you've got some thoughts there. What does that mean to wage pressures and ultimately the influence of wage growth on inflation?
Yeah, definitely. It's an important story that the labor market really is loosening. We see that in both the U.S. and Canada. I think we're right on the border now of what both central banks would maybe consider, not just a loosening labor market, but an outright weakening of the labor market, moving beyond maybe natural rates of unemployment. And you would expect then that as the labor market is weakening even more, moving beyond that, pre-pandemic balance to, excess supply, that should mean downward pressure on wages slowing even more. And then ultimately, that's what gets those, that underlying inflation, services inflation, something closer to target.
You do expect the Bank of Canada to cut in just a couple of weeks' time. It's due to make a policy announcement on July the 24th, and you're expecting another 25 basis point reduction, correct?
Yeah, exactly. We'll get a lot of important data next week. The business outlook survey, obviously CPI, that will be the most important read before that July meeting. But I do think probably officials are getting worried that activity is slowing in the U.S. and that means that maybe the bottom in activity in Canada is not in. Maybe we're not in a more of a recovery phase, and that is that means a wide output gap for longer than expected. That means even more downward pressure on the inflation outlook. So yeah, I do think the BOC is going to be cutting again in a couple weeks. And
do you have an outlook on the Canadian dollar, which is significantly influenced by the actions and perceived future actions of the two central banks?
Yeah, no real, forecast, but in general, I mean, that will be driven by interest rate differentials. I think if anything, maybe those look a bit more, in line with my forecast, and so maybe that's not, too much more of a move in the Canadian dollar. But as we do, I think, price more cuts for the Fed. That's really where we're out of consensus versus the market. We do think the Fed is cutting every meeting once they start, so every meeting starting in September and every meeting after that. That maybe would mean a weaker dollar. That's not quite priced. A weaker U.S. dollar, I should say. But yeah, in terms of that interest rate differential, it looks relatively fair, I think.
Okay, let's go back to where we began. That's the inflation report coming in the U.S. on Thursday. Tell us about some of the numbers beneath the headlines that you'll be looking at when that release is made.
Yeah, I think the most important number to watch maybe is what happens with shelter inflation. So we had this slowing in core inflation in May. A lot of that was concentrated in various services components, excluding shelter. Those can be volatile month to month, would probably expect some rebound there. But I think shelter will be the more important story of this June number. There was actually some idiosyncratic strength in May. If you looked at the regional details, some very strong shelter in New York and the Northeast. That shouldn't repeat in the same way in June, which means that you get a lot more slowing in that region, and other regions have already been slowing. And that can go a long way to convincing the Fed that there is this more confidence that inflation is sustainably easing.